If you secured a historically low rate on your 30-year fixed mortgage, you probably consider it your single greatest financial asset. You locked in a great number, and now you are determined to protect it. That predictable monthly payment feels incredibly safe. You know exactly what's leaving your checking account every month for the next 3 decades, and that consistency creates a powerful sense of security. But that comfort comes with a steep trade-off. While you're enjoying that predictable payment, your actual wealth is sitting idle. You have traded your cash flow for a static schedule. Look closely at your statement. No matter how low your interest rate is on paper, the bank structures that 30-year schedule to front-load the interest. For the first 15 years, you are primarily paying for the privilege of borrowing, barely making a dent in what you actually owe. Clinging to that low rate means accepting a system that slowly drains your capital in a low-yield environment. To build wealth effectively, we have to stop optimizing for the lowest monthly payment and start optimizing for how much of your income actually stays in your pocket. When it comes to building equity in your home, you essentially have 2 levers you can pull, one passive and one active. This diagram shows the traditional approach on the left. That is lever 1, passive appreciation. You wait decades for property values to rise, completely dependent on slow, unpredictable market cycles, while making your scheduled payments. Now look at the right side. This is lever 2, the all-in-one, or AIO, engine. Here, you use your daily paychecks to systematically force equity growth by applying your income directly against your principal. The traditional model asks you to be a passive observer of your own wealth. The AIO requires an active, disciplined mandate to take control of your cash flow. To figure out what works best for your specific life stage, we need to strip away the illusion of the monthly payment and objectively evaluate the mechanics of both strategies. With a traditional 30-year mortgage, the inputs are straightforward. You borrow a lump sum, agree to a fixed interest rate, and make 360 identical payments. The math behind those payments heavily favors the bank. They legally structure the amortization to collect their profit up front. For the entire first half of that loan, the majority of every dollar you send goes straight to interest. The AIO operates on a completely different set of mechanics. It functions as a dynamic, simple interest account, acting like a giant checking account that happens to have your home loan attached to it. Instead of keeping your income separate from your mortgage, you route your primary paycheck directly into this AIO line of credit. It becomes your central treasury. Because your entire paycheck hits the principal balance immediately, your total amount owed drops the moment you get paid. It sits there, holding your principal down before you even start paying your monthly bills. Here is the specific trade-off. Interest on the AIO is calculated daily, based on that newly lowered principal. It kills the loan up to 3 times faster, but it requires you to actively manage your deposits and abandon the set-it-and-forget-it convenience of a standard mortgage. When you replace a static debt obligation with a central treasury, your trapped home equity wakes up. It becomes a dynamic, high-performance cash flow engine. Let's pull the emotion out of the low-rate debate and look at the actual math over a 25-year timeline. This chart tracks the net wealth of 2 identical scenarios. Line A represents the traditional path, keeping a 2.875% interest rate and making standard, predictable payments for 25 years. Notice the volume under the curve in these early years. Despite that great rate, over $248,000 is lost strictly to front-loaded interest. Now look at line B. This active path accepts a higher interest rate on the AIO system, but deploys daily deposits directly against the principal. By attacking the average daily balance, that exact same home is completely paid off in just 9.9 years. Once the debt is gone in year 10, sibling B takes the former mortgage payment, let's say $2,500, and redirects it into an index fund. Assuming a historical average market return of 10%, that compounding interest turns former debt into over $1.1 million in new wealth by year 25. This comparison shows that for homeowners with consistent income, the mechanical efficiency of paying down principal daily can outweigh the benefits of a lower interest rate on a traditional schedule. But a high-performance vehicle only works if you know exactly where you're trying to go. So who actually benefits from deploying this strategy? The first ideal candidate is the capital-efficient entrepreneur. For a business owner, cash flow is constant. By flowing daily business deposits through the AIO line, they artificially depress their daily loan balance, drastically lowering their true borrowing costs. The trade-off is discipline. They have to stop leaving cash sitting idle in low-yield checking accounts. But doing so ensures that instead of capital sitting static, it is immediately available to be redeployed into new business ventures. The second ideal candidate is the pre-retiree, 50 and over, looking for absolute financial security. For this group, aggressively paying down the principal establishes a massive, accessible line of credit that acts as a financial anchor. They must actively manage their daily paydown today, but in exchange, they gain serious job loss protection and completely eliminate fixed monthly housing overhead right before entering retirement. Whether you are maximizing business capital or securing a debt-free retirement, the mechanics of the AIO only deliver results when they are explicitly aligned with your specific current life stage goals. We need to do a reality check. Accessing these exact mechanics requires clearing some very strict qualification barriers. This graphic details the 4 mandatory underwriting requirements to access the AIO. You need a 700 minimum FICO score, a maximum debt-to-income ratio of 43%, at least 20% equity in your home, and proven liquid reserves. The strictness of these rules is the ultimate trade-off. This tool is built exclusively for financially disciplined homeowners. It cannot and will not act as a bailout for bad consumer debt. So you have to ask yourself, is your current static mortgage strategy the central inefficiency holding back your wealth plan? To find out, you need to calculate your effective rate. That is the actual cost of your capital over time, and it's the only metric that matters for accurate financial modeling. Book a 15-minute capital efficiency audit with us today. We will sit down, run your specific numbers, and calculate your exact timeline to zero debt. This is not a commitment to lend. All loans are subject to credit approval. Epic Lending is an equal housing lender. NMLS number 1936984. For licensing information, please visit nmlsconsumeraccess.org. Total homeownership isn't found by passively waiting out a 30-year term. It's found by actively commanding your capital today.